Hello, today we're going to be looking at this difficult question: evaluate the significance of global trade imbalances to the global economy. This is a question which hasn't come up on the new syllabus yet, and also includes the words global there, which means that we need to be talking about two countries, a very easy way of losing marks if you don't realise that the question requires you not just talk about one economy. Before we start the question, let's take a look at some of the data. I'll let you just look over that, just pause on it and have a look at some of those areas you see there. Now that you've done that, can you pause it and think about what are your 2 points and 2 diagrams that you're going to look at? Okay, coming back. Well, first of all, the difficulty of this essay is that you could not only misunderstand what was meant by global, but you could also misunderstand what the current account deficit is and global trade imbalances in general. So very important not to mix up with the budget deficit. Very important to be able to understand the components of the current account and the financial account for this essay. The 2 points that I've chosen are protectionism, a trade diagram on the left-hand side, and what we'll be looking at later on is systemic risk and asset price increases and macroeconomic instability, which is a hard point, but I think one that ties nicely into the financial market area of the course and something that we should take a further look at. So protectionism, pause the video in a second and map out what do you want to say for this, and then think about what the evaluation would be as well. Okay, coming back. So the difficulty I think here is to say, well, why does protectionism, where is it coming from? What's that got to do with global trade imbalances? Well, you first of all need to know that the US has the current account deficit, and that may not be sustainable. That Donald Trump at least thought that that was a very negative thing for the US economy and wanted to rectify it. And the narrative was that it was because of unfair Chinese competition. And therefore, in order to rectify that, we might need to put tariffs on Chinese goods exports to the US. Again, we've got, this is all very, just writing out your notes, essentially, the situation before, once you add a tariff on, and the situation afterwards as well. That's all, I think, something that you can get for your notes. One thing that I do want to point out, though, is I've used a real-life example of solar panels, which was something which the US and the EU have claimed have been unfairly traded by China due to high subsidies. Now, in order to get a global impact, we not only want to, we have a global impact already. We've referred to the Chinese exporters of solar panels, and we've also referred to the US producers of solar panels for the domestic US market. So we've got 2 countries effect on this diagram, which is why it's a good diagram to do for a global effects essay. However, we could take it a little bit further. We could say that there's loss of consumer surplus A, B, C, D, of which B and D are not transferred to other actors, other stakeholders. And therefore, we are seeing that there is a global effect on world inefficiency. We have now meant that production has been taken from an efficient producer with a comparative advantage, China, and it's been transferred to a less efficient producer, the US, and therefore that has implications for the world production of solar panels. Now we can take that further when we talk about the retaliation. Now hopefully you've thought about this. Again, the retaliation has to be the evaluation we're going to use here, and we could have a look at some of the products that China then retaliated on. And so we've got things like soybeans, for example. And therefore, we can then make further comments on the disruption to trade in the theory of comparative advantage. We could look at further impacts to world efficiency. Now, there's a really nice point here. There's 2 really nice points here. You could, first of all, use this and say, well, hang on a minute. If we look at the big US tariff actions that we saw through the 2018 to 2020, they were not matched by Chinese retaliations. There were retaliations, but they were not nearly as big in magnitude. This table here and the interdependence of China and US partially explains that, as the US is tariffing China. China does not want to get into this box, into a full-blown trade war, and therefore retaliates at a lesser degree, which is quite interesting. We could also talk about Vietnam and Mexico and say, well, if the US is tariffing China, they stand to benefit from them as their exporters now become relatively more price competitive to the US. So something interesting to talk about there as well. You could talk about the World Trade Organization as well. Probably we've got too many points now, but clearly the mediation role of the World Trade Organization, keeping trade free, may well result in this trade war being less severe than otherwise if we didn't have this organization existing. Although you could challenge how powerful the World Trade Organization is, and I think probably it's not nearly as powerful as perhaps we would like. Right, our second point, asset price bubbles and macroeconomic instability. Now, for this point, we need to be able to link this global trading relationship to the American house bubble, house pricing bubbles and instability, that big unstable curve that we're seeing there, and linking that to Chinese holdings of US Treasuries, a difficult thing to do. Try to make the link, then come back and see if you got it right. Okay, so the difficulty here is linking all of this to the US current account deficit. Well, we need to understand that a US current account deficit, it's importing more than it's exporting, is mirrored by China's relationship with the US, where it's exporting more than it's importing, and they are mirror images of each other. China's inflows are greater than its outflows, and therefore the US's outflows are greater than its inflows. Now this has to be balanced up somewhere, and this is balanced up in the financial accounts. So there is a flow, a net flow from the US to China in their current accounts. But this must be matched by a net flow from China to the US in their financial accounts. Well, how does this work? What happens? Well, China earns more from its export spending than it spends on imports, and that means its financial system has a lot of excess savings. Now, those could be invested in China, and they have been into huge infrastructure projects. But where do they go when those infrastructure projects have been exhausted, or we've already invested in those? Well, there are also high earnings from those savings that could be made abroad in, for example, the US. And so that results in large amounts of injections into the US financial system, as we see there. Injections from that, so when we see the Chinese government holding huge amounts of US government bonds, we see there 850, sorry, my screen's just gone again. We saw $859 billion, I think there. That represents a huge injection into the US financial system. Where does that go? Well, ultimately it goes into asset markets, into stocks and housing. Now, what happens to the housing market when we see lots of loans being ready to be given out? Well, the demand and supply for housing, you'll see the demand shifting to the right, as we see there. And as the price rises, because of easy loans and low interest rates, then some consumers may think, well, hang on a minute, the price is rising, I should invest in this asset. I should buy a house. I don't need to, not for the purpose of living in it, but just simply for the purpose of that I want to speculate and make money from it. And that drives demand up again to the right to a certain point where prices become unrealistic, they become too high, and any negative news about house price movements, as soon as they go down by a little bit, if lots of consumers have houses which they do not live in, they just bought for speculation, often because of borrowed money, they will then sell them very quickly, and as they sell them, you'll see the supply shifting out again and the price dropping back down again. So you'll see this process of housing price bubbles as the price moves up very quickly and the housing price crash as it moves down very quickly. And all of that is driven by excess borrowing. And all that excess borrowing is coming from, well, not all of it, but some of it is coming from the excess savings which are coming out of China. Now, as a result, as the house prices crash in the US and other places around the world, then the AD in the US is going to fall as well, as consumers feel a wealth effect, their consumer confidence falls, and therefore they reduce their consumption. And we see AD shifting to the left, and we see recessions and macroeconomic instability. I don't know why I've written stability there, that should be instability. And so you can see that, well, perhaps investment is going to be impacted by this as well, and this is certainly not conducive to a stable long-term growth that we are looking for. Now, I think that that view it can really be challenged. And if we're saying that, well, growth is unstable and asset prices are all because of Chinese financial account service, I think that's a little bit unfair. And so evaluating, we could put the other way around. Well, surely this growth is mutually beneficial. So how is that? Pause the video, think about how actually you can argue the other way. Okay, coming back. Well, those loanable funds haven't just been used for houses. They have funded all sorts of American startups. They have funded for Silicon Valley, lots of new technology, lots of investment, and that has all been very, very beneficial to US economic growth. China has seen high export-led growth. It's reinvested that in other areas as well. And we've also seen the Belt and Road Initiative, infrastructure projects across the world being funded by these excess savings as well. So it seems unreasonable to suggest that these excess savings have simply just created asset price bubbles. They've also resulted in lots and lots of useful growth as well. You could also challenge here. It seems unfair, really, to say that these excess savings automatically result in a bubble. What about the role of the US regulator? What about the role of regulating financial markets in the US to prevent these bubbles? So you may put the blame there as well as to why, for example, income verification checks were not included where US consumers, US house buyers wanted to buy houses. The money's available, but why did we not check to see whether they could actually afford it or not? In judgment, well, we could say, as always, it's a very good idea to break it down into long run and short run. And in the short run, it's certainly very beneficial. You'll see that the exports which the US are buying are driving that export-led growth for China. We can see that the financial account surplus for the US is driving US investment, it's driving US asset prices, and it's making US consumers happy. They can buy a lot of imports, and therefore it's a mutually beneficial relationship, and there are lots of synergies there. There was a program not long ago talking about Chimerica and the way in which they are interdependent with each other and mutually beneficial growth there. However, you could then challenge that with the long run and say, well, trade wars and asset bubbles, they may point to a long run negative impact of some of these issues, particularly if that relationship has become too close. Now, clearly, this is a political issue, and whether that is going to be considered to be negative, whether it results in negative effects, to a large extent depends on how this is viewed politically. And part of this is, well, is China trading fairly? Is it manipulating its currency? Is it giving too many subsidies for solar panel producers, etc.? Is the US managing lending and financial markets appropriately? That is a US government policy, which clearly you may argue that the US hasn't managed that properly, and therefore, if that runs into trouble, an easy way out of that is to put the blame somewhere else. And is China being used as a scapegoat? Well, possibly not. There are clearly issues with this relationship. Perhaps this would not be an issue if the World Trade Organization were able to do its job properly and monitor the trade between each country. And so perhaps a final point that we could make is, with a properly functioning World Trade Organization monitoring free and open trade based on the theory of comparative advantage, then it's likely that this short-term mutually beneficial growth will also be mirrored by long-term mutually beneficial growth.